Hi everyone, I'm making this video to explain the basic idea about the indirect method for the preparation of the statement of cash flows, also known as reconciliation of net profit after tax with cash flow from operating activities. First, let's look at the reconciliation of operating cash flows from 2013's warehouse's financial statement. Under the accrual accounting system, we know that firm's net profit is not necessarily equal to the net cash flows from operating activities. So these financial statement under the indirect method, the reconciliation of operating cash flows, explains the relationship between net profit and net cash flow from operating activities. Basically, we start from net profit. We take into account the non-cash items classified as investing or financing activities, and changes in assets and liabilities, we get net cash flows from operating activities. So from this net profit, after we add some numbers and subtract some numbers, and eventually we get the net cash flow from operating activities. For example, from the net profit, we subtract the increase in trade and other receivables. So in this video, I'm going to explain how are we going to prepare reconciliation of operating cash flows, the indirect method, and we are going to explain why do we subtract some numbers and why do we add some numbers to the net profit. Just have another look at the reconciliation of operating cash flows. We notice that depreciation and amortization expense is categorized under non-cash items. Gain on sale of property, plant, and equipment, so that's gain on sale of PPE or loss on sale of PPE, is classified as investing or financing activities. Loss on sale of PPE can also be categorized under non-cash items. Now let's look at the basic idea behind the reconciliation of net profit after tax with cash flow from operating activities. So we need to find out the relationship between net cash flows from operating activities and net profit. Let's start from the very basic idea here. We understand that incomes minus all the expenses equal to net profit. There are multiple ways to increase incomes, and also there are multiple ways to increase expenses. Let's just look at some commonly used items in textbook or in the very first accounting course. So, for example, when cash increase, it's likely that a business makes some revenues or makes some incomes. For example, when a business made rent revenue, we can debit cash, or if we haven't received cash yet, we debit accounts receivables. Debit cash, in this case, or accounts receivable, 100, and credit rent revenue. So, rent revenue increased by 100 will also lead to the increase in cash or the increase in accounts receivables. Another way to increase income is by making some gains. So, for example, we have a car that cost $10,000 historically. After we use it for 4 years, the accumulated depreciation is $4,000. That makes the carrying amount $6,000. Then we sold it for $7,000. That means we actually made a gain of $1,000. Here is the journal entry. So we made a gain of $1,000 in this case, and gain increase our income. Unearned revenue, if we made some revenue from unearned revenue, that will increase our income. For example, we reduce our unearned revenue by fulfill our obligation, by provide service, or by providing goods. So in this case, we debit unearned revenue, for example, $200, and credit revenue for $200 as well. So the decrease in our liability in unearned revenue also can be attributable to the increase in our revenue. Expenses, likewise, when expenses incurred, for example, salaries expenses incurred, we credit cash or we credit salaries payable. That means cash reduced and salaries payable increased. Depreciation is also a type of expense. Loss is also a type of expense, and I also give an example about loss making. For example, similar scenario here, the carrying amount of a car is still $6,000, but we only sold it for $3,000. That means we made a loss of $3,000. Prepayment. So if we have already prepaid rent for, let's just say, $1,000, after we stay in this property for like a month, we consume part of the prepaid rent. So we need to recognize the increase in rent expense and credit and recognize the decrease in prepaid rent. So the decrease in prepayment also shows that there's expenses incurred. Okay? So incomes minus expenses equal to net profit. Next step is we can substitute these items and these items into this magical equation. Let's hide these for now. So we see that after we substitute these items into this equation to replace incomes, and we substitute these items into the equation to replace expenses, the equation looks like this. The increase in cash plus the increase in accounts receivable plus gain plus the decrease in unearned revenue minus the decrease in cash plus the increase in accounts payable plus depreciation plus loss plus the decrease in prepayment equals net profit. After we open the bracket, we combine the cash items. So we have changes in cash plus these 4 items and minus these 4 items equal to net profit. So up to now, it's purely mathematical. Now we shift these items to this side, to the net profit side. Then we get the changes in cash equal to net profit plus prepayment plus loss plus depreciation plus the increase in accounts payable minus the decrease in unearned revenue and minus the increase in accounts receivable. So now we establish the relationship between net profit and changes in cash. So as we can see, the first thing we take care is non-cash items, depreciation and loss. Second step, we look after items classified as investing and financing activities. Here, it could be loss, it could be gain. Next, we look after the changes in assets and liabilities. So from this equation, we see that we need to subtract or minus the increase in asset plus the decrease in assets plus the increase in liabilities and minus the decrease in liabilities. In this way, purely mathematical, we establish the relationship between net profit and net cash flow from operating activities. So when we refer to the warehouse's reconciliation of our operating cash flow, we see that starting from net profit, warehouse also look after net cash items, for example, depreciation first, and then look after items classified as investing or financing activities, for example, gains on sale of PPE, and then changes in assets and liabilities, for example, trade and other receivables, inventory, and trade and other payables. And this is a very nice little summary here. So up to now, my explanation so far only focused on the purely mathematical manipulation here. Now I'm going to explain this part from accounting perspective. That is why we need to subtract the increase in assets from net profit to get cash, why we need to add the decrease in asset to get cash, why we need to plus the increase in liabilities, why we need to subtract the decrease in liabilities from the net profit to get cash. Now let's look at the relationship here by looking at these simple examples. Let's suppose your business starts with a cash balance of 0, and this relationship still holds. That's revenue minus expenses equal to net profit. So when you start your business with a cash balance of 0, that means you have 0 cash and also 0 net profit. Now, after providing service of $200, you haven't received cash yet, you record it under accounts receivable. The journal entry is debit accounts receivable $200 and credit revenue $200. This transaction has no impact on cash, but it affects net profit. It increased net profit by $200 because of the revenue generated. Now, to make both sides equal, we need to subtract $200 from this side. That is actually the increase in accounts receivable, which is an asset item. So this explained why we need to subtract the increase in asset from net profit. Now let's look at what if the customer paid us $100. after we received the $100 from the customer, we recognize that cash increased by $100, but this transaction has no impact on net profit. This side increased by $100. That means we need to plus $100 on this side to make both sides equal. And this $100 is the reduction in accounts receivable, which is an asset item. Another example is, what if we prepaid rent? After we prepaid rent, our cash reduced by $100. When this side reduced by $100, to make both sides equal, we need to reduce this side by $100 as well. And this $100 is the increase in asset. Now, if we look at inventory, this is the same logic. When inventory increased by $200, we recognize that cash reduced by $200. So when cash side reduced by $200, to make both sides equal, we need to subtract $200 from net profit side as well. And this $200 is the increase in assets. That is our inventory. Now let's get back to the rent. Let's just say after 1 week, your prepaid rent has been consumed by $50. So we need to recognize the rent expense of $50. At the same time, we credit prepaid rent to recognize the reduction in our asset. These transactions affect net profit side because rent expense incurred. When rent expense incurred, our net profit reduced by $50. When this side reduced by $50, we need to add $50 here to make both sides equal, because this transaction has no impact on our cash. And this $50 is the reduction in prepaid rent, in asset. Now, let's look at liabilities. Let's just say you hired someone to do some job for you, and you need to pay him $20, but you haven't paid him yet. That transaction can be recorded as debit salaries expense $20 and credit salaries payable $20. These transactions reduce net profit by $20 because of the increase in expense. However, this transaction has no impact on cash. When this side reduced by 20, this side remained unchanged. To make both sides equal, we need to add $20 at the net profit side. This $20 is the increase in liabilities. That is salaries payable in this case. Let's just say in a week, you paid $20 to your employee, to this person, to reduce your own liabilities. So we debit salaries payable by $20 at the same time to recognize cash outflow of $20. So cash reduced by $20. However, this transaction has no impact on net profit because there's no revenue item, no expense item. To make both sides equal, we need to minus $20 from net profit side. And this $20 is the decrease in liabilities. So this little example here explained the relationship shown here. Now, at the end of this video, let's just have another look at the summary here. So, to establish the relationship between net profit and cash generated by operating activities, we start from net profit. We first take into account the non-cash items, for example, depreciation and loss. And then we take care of items classified as investing and financing activities, for example, gain. And then we look at changes in assets and liabilities. Specifically, we need to subtract the increase in assets, add the decrease in assets, add the increase in liabilities, and subtract the decrease in liabilities from net profit to calculate net cash flow from operating activities. Thanks everyone for watching.